So also continue having this conversation on markets. Shreyash Devalkar is head of equity at Axis Mutual Fund. Is with us. Shreyash, good to have you with us here.
Good morning.
The broader market, Shreyas, I mean, take the NSE 500 group of stocks, for example, has been flat for a year now.
Yeah.
Right? A lot of dispersion within, but at a broad level has been done nothing for a year. What's your sense? Has there been enough time correction or not really? And although the problem is, even as that has happened, earnings expectations have continued to move lower. So where do we stand, Shreyas? At the late stages of this decline, sideways at price action, or something more here?
Yeah, sure. Good observation that you are making on the 1 year underperformance of broader market. And more important is, since you're highlighting NSE 500, it is earlier it was only about a large cap, but it is, if you look at the headline indices of mid and small, even there you are seeing that consolidation. This consolidation, if you notice, if you go into further details, then the way I look at it is the success rate. So how many in the flattish market, actually the market from peak is maybe 4-5% down or 5-6% down. In this market, how many stocks are positive? Absolutely positive, because of the end of the day, equity is about the positive returns. And then if you notice that, then you will notice that in the large caps, broadly 30-35% stocks are positive. In mid and small also, that ratio is somewhere around 35%. So what in other words, what is also highlight is it's not only about headline level market consolidation. It is also about few stocks are delivering positive returns, and that success rate is around 35% odd. And most of the stocks are giving a negative returns on a 1 year basis. This consolidation was warranted, no doubt on that, especially because of the higher valuation. One may always go back to earning decline or decline in the earning growth expectation, obviously not an earning decline per se, but that expectation cut was about to happen. Because when there is a sharp rally, generally the expectation run very high. When the multiples are at 50, 60, 70, 80 P, then in that situation, the room for error is very less. And generally the expectation of growth, it turns out to be very high, upwards of mid-teen and plus. Now, this kind of growth in an overall global scenario, it's not very easy. And when all the experts are predicting GDP growth rate, which is around 6.5, when everyone is predicting the growth rate of the global growth rate also lower, in that situation, it becomes very difficult for companies to outgrow the nominal GDP growth. And that's where, since the returns are converging to nominal GDP growth. So on a 1 year basis, they are lower than nominal GDP growth, definitely. But on 2 year, 3 year basis, as the returns start converging to nominal GDP growth, I think that is when I would call out that yes, now the consolidation is behind us.
Yeah, absolutely, and we need to see that growth start to pick up, so it starts showing up in corporate earnings as well. Shreyas, great to have you on. So tell us, across your portfolios, I mean, when you talk about the growth play, I mean, obviously some funds are going to be more value oriented, some will be, based more on a momentum philosophy. But if you talk about pure alpha and pure growth, then which are the segments, the sectors or the themes where you still have clear visibility over the next year, year and a half?
So if we go by even these results, though it is not over yet, it's maybe 30-40% over by now. In mid and small cap, it is not over yet, definitely. Broadly, the trends which were on for some time, they continue. I have not seen much difference in the trend across the sectors. Now, since you talk about the momentum where it is expected to continue, you just take the trends in the broader segments like electronic manufacturing services, where the trend has been good. And in the recent result season, the few companies which came out with the result, it tend to continue. On the capital goods side, one observation was the deviation was especially that earlier capital goods growth was broad-based. Now it looks like that is more concentrated in power T&D, and it doesn't look that broad-based, especially on the margin front, because the sector also has seen a lot of margin expansion in last 2 to 3 years. So on both margin as well as the growth front and order inflow front, in capital goods, the growth looks now more getting only in the power T&D capex spend than the broader market. The other part of the growth thematically has been in the travel tourism space. It has been in the hospital space. In all these segments, probably there are no earnings surprises, but I don't think there are much disappointments as of now in these spaces. If you take even in this retail growth, that is the retail industry, that is consumer services, even there, I don't think there are much disappointment, which includes quick commerce, which includes food delivery, which includes retail and travel tourism. So this is the back on the consumer side, which has had a good traction. There, I don't think there are much issues. Only on the consumer or high-end discretionary, the autos, which has showed slowdown. There, we are not seeing even now in the recent monthly numbers. There are not much revival.
Yeah, no, absolutely, Shreyas. I mean, and thank you for listing out some of those sectors, because this is just what we're discussing internally as well, in terms of where is the growth visibility. And you mentioned power T&D. We were speaking to a T&D company, transformers and rectifiers, just a couple of minutes back before you joined in, and they've done really well. On power specifically, while you like T&D, any sense on the integrated players? And those stocks have not really taken off. I know you can't talk stocks, but I'm saying, large companies like NTPC or even Tata Power, and we'll be speaking to Tata Power in the next couple of minutes, the market doesn't seem to be taking a liking to the integrated large players. And it's only focused on the distribution segment. Why do you think that is the case?
So there has been always, so it's not only now, if you go back, so it's power is end of the day is infrastructure play, right? So earlier there used to be road, rail, and so on. Historically, if you see that as far as the wealth creation is concerned in the stock market generally distinguish between the asset owners and the capital goods companies, right? When it comes to both multiples as well as the wealth creation opportunities, there are reasons for it, because end of the day asset owners are balance sheet heavy and so on, and that's where their growth rate you cannot just extrapolate compared to the balance sheet growth, and it comes with the cost of obviously equity dilution or the debt creation. So in that sense, market has always distinguished between the two. So whether it is earlier eras, it used to be rally in the companies which are asset owner in the road space or in metro space. It's a similar thing is happening here. So now generally in the initial part of that theme, the asset owners do well by way of re-rating, but when it comes to the continuity, then one need to look at the valuations in the asset owners, and that's how the differentiation in the stock behavior starts in this.
Okay, all right. Shreya's final question before we let you go. IT, the Nifty IT index actually has been a relative underperformer. But I was looking at two data points as put forth by HDFC Securities. One is the valuation discount to the NASDAQ is at around 20%. During COVID, it bottomed out at around 30%. So that's, expanded quite a bit. And the premium to the Nifty valuation itself has come down to around 15%. Normally, we have seen it bottom out at around 14%, and the peak has been 50%. So that's the valuation argument. But do you think, at current reckoning, IT is forming some sort of a basing out process where you want to buy stocks for the longer term, going by the recent underperformance that you've seen in tech?
Sure. Actually, on your valuation argument, I would also add one more metric of valuation, which is a DCF-based valuation. Mm-hmm. If you do a DCF-based valuation, then also not many sectors you will get a limited downside. So IT on the DCF-based valuation also, if one try to do with the current expectation growth rate of mid-teen to not mid-teen, it's a mid-single digit to high single digit. Broadly, this kind of valuations look good on that front as well. But now in IT, the trouble is on the indecision at the client end. And with that trouble, this indecision is getting too much extended. What we have observed in the recent result season also, though some companies are reporting, a deal flow in this quarter, but net deal flow for the industry is not as good. So there are gross deal flows. So where someone is losing, someone is gaining. So what is happening here is there is a consolidation, winter consolidation, which is playing out because there is no net deal flow addition for the industry. In this context of this winter consolidation, the real trouble is there are 2-3 sets of companies now in the market. So one company is, so without naming, some set of IT companies, what they are doing is they are trying to use their margin or balance sheet for some deals, while some companies choose not to, and they are focusing on free cash flow to PAT, which is the traditional metric. And with this differentiation in the strategy, you are seeing the rotation in the same deals going from one to other. In this situation, market generally reads through this. So there are companies you will find lesser growth, but then your free cash flow profile is very, very intact, while there are companies which are seeing good growth, but then those metrics are not intact. So all in all, since their overall deal flow is not that great, until the time that situation comes back, it's very difficult to be positive on that. Definitely, valuation is a good argument to have, and on that front, as I concur with you that even on 2-3 metric of valuation, the sector looks very attractive.
Okay, all right. Take that point, Shreyash. Good conversation. Thank you very much for joining in and sharing that perspective with us this morning. Appreciate it. So that's the view coming in from Axis Mutual Fund.